Hello everyone and welcome to another episode of Ask NDB Wealth mid-month market update for the month of July. I'm Chamal Karnathan and this is Tejita Polgolo who will start off with the interest rate update.
Thank you, Chamalika. In the 5th Monetary Policy Review for 2023, Central Bank reduced its policy rates by 200 basis points. Post DDO announcement in June, the risk premiums attached to treasury bonds reduced significantly. As a result of that, we saw 5-year treasury bond, which was trading at 25% levels, was down to 14% levels in the first day of trading following the announcement. With the inflation seen easing off, the treasury bill weighted averages dropped by 250 to 400 basis points across all tenors by mid-July compared to June. The 91 days, 182 days and 364 day weighted averages stood at 19.08%, 16.95% and 14.04% respectively in the last week's treasury bill auction. Further, after a lapse of 4 months, a treasury bond auction was held in 13 July where we saw a 5-year treasury bond and a 7-year treasury bond which is maturing in 2028 and 2030 was auctioned. The central bank was able to raise 50 billion from each of the maturities with weighted averages of 15.74% and 15.67% respectively. Fixed deposit rates also significantly dropped in line with treasury yields as most of the commercial banks quote 12% for 1-year fixed deposit rate. The government is seeking parliamentary approval to increase its debt ceiling by 9 trillion, which might have an impact on the yields. The AWE PLR dropped by 78 basis points to 18.69% from 19.47% recorded in end of June. Moving to inflation, the CCPI dropped to 12% in June compared to 25.2% in May, as both food and non-food categories saw a decrease in prices. The CBSL expects faster disinflation due to high base effect and appreciation of LKR, and central bank also expects the inflation rate to be remain at single-digit levels in the foreseeable future. Over to Chamalika to talk about international inflation.
So in the global front, we saw in US inflation cooling off with the US CPI coming down to 3% in June. Compared to a high of 4% in May, despite the fact that it was the inflation is higher than the 2% target set by the Federal Reserve. Investors and analysts speculate that the contraction monetary policy set by the Federal Reserve is coming to an end. In Sri Lanka, we saw the fiscal accounts being released for the month of May, and tax revenues have increased by approximately 38%. For the month, and the country is witnessing a 53 billion surplus, which was up against the deficit predicted by IMF. Despite this, we saw the current spending increase by 52%, and this is mainly due to the fact that interest rates were high during at the beginning of the year. The government also announced the easing of imports for all items except vehicles, and this process is expected to be conducted in 2 stages, which will end in the first week of September. We saw tourist arrivals hit the 100,000 mark in June, and we see that trend continue into July with 24,000 tourists arriving during the first week of July. Moving on to equity markets, we saw equity markets rally at the start of July. This is mainly due to a positive announcement for the banking and financial sector after the debt restructuring announcement. We saw ASPI and S&P SL20 move up by 12.2% and 14.5% respectively for the first 2 weeks of July, and market turnover increased as retail investors and foreign investors started coming in as the macroeconomic conditions of the country was improving. Thank you.
Thank you, Chamalika. Thank you for joining with us for another episode of Ask NDB.